So imagine opening your Zillow app on a random Tuesday, right? And the algorithm tells you your house just skyrocketed in value by like $100,000.
Oh, best feeling in the world. You feel like a genius.
Exactly. You feel wealthy. Your net worth looks fantastic on paper. But then you walk into work an hour later and your boss pulls you into an office to announce a massive 30% pay cut to your actual salary.
Ouch. Yeah, that ruins the morning pretty fast.
Right. Because you can't buy groceries with a Zillow estimate.
Yeah.
And you certainly can't pay your mortgage with, unrealized real estate gains when your actual day-to-day cash flow just tanked.
You're cash poor, but asset rich.
Exactly. And that jarring, bizarre contradiction, that is exactly what happened to Cincinnati Financial Corporation, ticker symbol CINF, in their second quarter of 2026. Welcome to This Talk Ticker's Deep Dive, where we are taking their massive, jargon-heavy Q2 earnings call and distilling it down into a rapid-fire data-forward briefing for you, the retail investor.
Yeah, and we know your time is valuable, so we're getting straight to the exact numbers, the story behind them, and a firm bottom line opinion on the stock. Because the discrepancy between the headline and the reality is just staggering this quarter.
It really is. I mean, if you pull up any standard financial screener right now, the top line net income figure for Cincinnati Financial is $1.3 billion.
Which is huge.
Right. $1 billion quarter usually signals an unstoppable business operating at just peak efficiency. But if you actually dive into the earnings call transcript and the financial supplements, it reveals a completely divergent reality.
Yeah, out of that $1.3 billion, a massive $882 million is purely an after-tax fair value increase on their equity portfolio. It's entirely driven by mark-to-market accounting rules.
So wait, that means it's phantom income. It's the Zillow estimate from my analogy.
Precisely. The stock market had a great run. The equities held in their massive investment portfolio went up in value. And, well, Financial Accounting Standards Board rules dictate that those unrealized gains must be reported on the income statement.
But they didn't sell those stocks.
No, they didn't. They didn't ring the register and deposit $882 million into a checking account. It's just paper wealth, masking a very, very different operational reality.
So for a retail investor holding this stock, which number actually reflects the health of the company? Because if the $1.3 billion is just paper, we need to know what the day job is actually paying.
Right. So we have to look at the non-GAAP operating income to see the actual cash-generating power of the insurance business itself. When we strip out all those wild equity market fluctuations, the operating income for the quarter came in at $224 million.
Okay, $224 million. And how does that compare to, say, last year?
Well, compare that $224 million to the $311 million they generated in the exact same quarter last year.
Oh, wow. So that is a massive drop.
Yeah. The core engine of the company, like the actual daily operations of underwriting risk, produced significantly less profit.
So there's the 30% pay cut at the day job. And the severity of that pay cut becomes undeniable when we look at the holy grail metric for any property and casualty insurer, and that's the combined ratio.
Right, the combined ratio.
For Q2 2026, Cincinnati Financial reported a combined ratio of 100.8%. Can you break that jargon down for anyone new to evaluating insurance stocks?
Yeah, absolutely.
Yeah.
The combined ratio is basically the simplest way to determine if an insurer is actually good at their primary job. It's the sum of incurred losses and operating expenses measured as a percentage of earned premiums.
Okay, so what's a good number?
Well, a ratio below 100% means they are making an underwriting profit. A ratio above 100% means they are paying out more in claims and expenses than they're collecting in premiums.
Got it. So at 100.8%, they are technically operating at a loss.
Yes. For every dollar of premium they took in, they paid out roughly $1.01.
They are literally losing a penny on every single dollar of their core product. And, the context makes it worse because that 100.8% isn't just a slight dip. It represents a 5.9 percentage point deterioration from the same quarter last year.
Right. The core underwriting profitability went entirely in the wrong direction.
Add to that a top-line growth rate that is just crawling. I mean, net written premiums grew by a sluggish 3% for the quarter.
Just 3%.
So we are looking at a scenario where the company is barely growing its revenue, and the revenue it does have is operating at an underwriting loss. All of this hidden behind a $1.3 billion paper gain from the stock market.
Exactly. And the thing is, the equity markets are completely outside of management's control. Steve Spray, the CEO, he can't dictate what the S&P 500 does.
Obviously not.
Right. So what he and his underwriting teams can control is how they price risk, how they manage expenses, and how they allocate capital. If the combined ratio sits at 100.8%, we have to determine if this is a structural failure in their pricing models.
Meaning they are fundamentally misjudging risk.
Right, exactly. Or we need to know if it's just an anomaly driven by external factors that, distort an otherwise healthy machine.
Okay, so if the day job is paying less, we need to find out exactly where the money is bleeding out. Let's look at the actual claims pulling that combined ratio over the profitability line.
Yeah, let's get into the culprits.
The immediate culprit identified in the transcript is catastrophes. Mother Nature, essentially. Catastrophe losses added 2.3 points to the combined ratio. But what does that actually mean in industry terms?
So in actuarial terms, a catastrophe isn't just a bad storm. The insurance industry, specifically through organizations like Property Claim Services, they assign a serial number to events that cause a certain threshold of insured property damage across the industry.
Like a financial threshold.
Yeah, usually $25 million or more. So when we see 2.3 points of catastrophe losses, it means organized, large-scale events hit their book of business.
Okay, so if we remove those specific catastrophe designations, would the combined ratio have dipped back down into profitable territory?
It would have, yes. It would have dropped below 100%.
But the pain wasn't distributed evenly across their business, was it? The commercial lines segment, which is where they insure physical businesses, factories, retail spaces, took a brutal hit.
Yeah, it was rough.
The combined ratio for commercial lines spiked by 11.2 points, landing at 104.1%. And the transcript notes that almost 5 of those points were driven entirely by higher catastrophe losses compared to the prior year.
Right, and you have to realize commercial properties often have a much higher concentration of risk. If a severe convective storm, and that includes hail, straight-line winds, tornadoes moves through a major metropolitan area, the damage to a sprawling commercial warehouse roof is exponentially higher than the damage to a single-family home.
Oh, that makes sense. A warehouse roof is massive.
Huge. Or think about an inventory-heavy retail center. And the Midwest, where Cincinnati Financial has a historically strong footprint, has seen a documented increase in the frequency and severity of these exact types of storms.
Right. But it wasn't just Midwestern hailstorms eating into the profits. This is where the source material gets truly fascinating, I think, because the global interconnectedness of risk is just fully on display here.
Yeah, the global segment was wild this quarter.
The transcript highlights the performance of the Cincinnati Global segment, which operates internationally, primarily as a syndicate out of Lloyd's of London. That specific segment ran at a staggering 110.8% combined ratio.
Yeah, and the mechanics of a Lloyd's syndicate are entirely different from, say, selling a standard policy in Ohio. Syndicates take on highly specialized, complex, and often massive risks by pooling capital.
What kind of risks are we talking about?
They insure ocean marine cargo, aviation fleets, energy infrastructure, and crucially, political risk. So when Cincinnati Global writes business in this market, they are exposing their balance sheet to global macro events.
Which explains the highly specific call-out from their CFO, Mike Sewell. He explicitly mentioned a $10 million loss tied directly to the conflict in Saudi Arabia.
Which is just crazy to think about.
Right. Think about the gravity of that for a second. An insurance company headquartered in Fairfield, Ohio, is taking an 8-figure hit on their quarterly earnings because of geopolitical conflict in the Middle East.
It really highlights the reality of political risk and aviation insurance in the modern era. When conflict erupts, supply chains are disrupted, vessels are damaged, infrastructure is compromised.
Don't standard commercial policies usually exclude war, though?
They do. Standard policies have strict war exclusions, but the specialty markets in London specifically underwrite political violence, terrorism, and aviation war risks. So a $10 million loss suggests they had exposure to a very specific high-value asset or operation caught in the crossfire of that regional instability.
Wow. And the bizarre anomalies didn't stop at international borders either. Sewell also detailed a $7.5 million contingency loss right here in the domestic U.S. And this was a loss driven entirely by a heat wave.
Yeah, that one caught a lot of analysts off guard. Contingency insurance, which is often known as event cancellation insurance, is a massive industry.
Right, like for the Olympics or something.
Exactly. When organizers plan a major outdoor music festival, a professional golf tournament, or, a sprawling industry convention, they spend millions on logistics, vendor contracts, security, all before a single ticket is scanned.
Okay, so they purchase these contingency policies to protect that upfront investment if the event gets shut down.
Right. If it cannot proceed, the insurance pays out.
But usually you assume the risk is like a hurricane making landfall or severe lightning forcing an evacuation, but extreme heat. A $7.5 million payout because it was simply too hot.
Well, the underwriting models are having to adapt rapidly. We're seeing a shift toward parametric triggers in some of these policies, or at least highly specific indemnity clauses related to human safety.
Parametric triggers, what does that mean?
It means the policy pays out automatically if a specific measurable metric is hit. So, for example, if the wet bulb temperature, which measures both heat and humidity to determine the threshold of human survivability, reaches a point where local authorities actually mandate the cancellation of outdoor activities, the insurance policy is triggered.
Oh, wow. So it's not even up for debate. The thermometer hits a number, the event is legally forced to cancel, and the insurer writes a check.
Exactly. The vendors demand their money, ticket holders require refunds, and the insurer absorbs the financial shock. As baseline temperatures rise globally, extreme heat transitions from an unpredictable anomaly to a systemic modeled risk that actuaries must price into the premium.
Which perfectly brings us to the revenue side of the equation. If they are paying out $10 million for Middle Eastern conflicts and $7.5 million for canceled music festivals, they need to be bringing in enough premium to cover it. But as we noted, top-line premium growth was a very sluggish 3%.
Very slow.
Now, CEO Steve Spray spent a significant portion of the call defending this number, claiming it's a deliberate strategy he calls pricing discipline.
Yeah, and concept of pricing discipline is it's fundamental to long-term survival in the insurance sector. It means the underwriters are walking away from business if the premium doesn't adequately compensate them for the modeled risk. They're prioritizing margin over market share.
Okay, let me push back on this cynically as a retail investor, because pricing discipline is the oldest excuse in the Wall Street playbook.
It really is.
Right. I mean, if a tech company reports 3% growth, the stock plummets and the CEO gets fired. If I'm looking at this, 3% growth combined with a 100.8% combined ratio looks like a company that is just losing market share to hungrier, more aggressive competitors like Chubb or Travelers, and they're using discipline as a convenient mask for a failing sales strategy. So how do we know this isn't just an excuse for losing?
It's a fair question. To answer it, we have to look at the composition of that 3% growth, which management actually broke down during the analyst Q&A. Greg Peters from Raymond James pushed them on this exact point.
Oh, I'm glad someone asked it. What did they say?
The management team clarified that 2/3 of that 3% growth is coming from pure rate increases.
Meaning they are going to the exact same customers, offering the exact same coverage, and demanding a higher price just to renew the policy.
Correct. And the ability to achieve pure rate increases demonstrates actual pricing power. If they were truly losing their competitive edge, clients would simply take their business elsewhere rather than accept a higher bill.
That makes sense. They just shop around.
Exactly. The retention of those clients at higher rates indicates the underlying business remains sticky. But the remaining 1/3 of that 3% growth requires careful analysis because it comes from what the industry calls increased exposure.
Yeah, I want to break down exposure because it sounds like they are taking on more risk, but it actually ties heavily into macroeconomic inflation, doesn't it?
It does. The term exposure simply refers to the underlying value of the asset or metric being insured. So, consider a mid-sized manufacturing facility. 5 years ago, the cost to rebuild that facility might have been $10 million.
Okay.
Today, due to the staggering inflation in commercial construction materials, steel, concrete, specialized labor, the cost to rebuild that exact same footprint is $13 million.
Right.
The insurance policy automatically adjusts to cover that new $13 million replacement cost, and the premium increases proportionally.
So they aren't necessarily insuring a new factory. The existing factory just got more expensive on paper?
Precisely. And the same mechanic applies to commercial casualty insurance, which is often priced based on a company's payroll or sales receipts. If a business gives its employees a 5% cost of living raise due to inflation, the overall payroll increases.
And because the workers' comp or liability premium is calculated as a percentage of that payroll, the insurance company collects more premium.
Exactly. It is passive revenue growth driven entirely by macroeconomic inflation, not by the sales team winning new accounts.
So the top line is barely growing, and the growth they do have is mostly just inflation and rate hikes. And nowhere is this intentional slowdown more evident than in their personal line segment, standard home and auto insurance. It grew by an anemic 1%.
Barely moved.
But the transcript reveals this is a highly calculated retreat. They are heavily retrenching in California, specifically pointing to wildfire risks.
Yeah, California is a tough market right now. The regulatory and environmental landscape there has created a full-blown crisis for property insurers. Under Proposition 103, insurance companies in California must get approval from the state's Department of Insurance before raising rates.
Right, which sounds good for consumers in theory.
In theory, yes.
Yeah.
But for years, the department suppressed rate increases, even as the frequency and severity of wildfires in the wildland-urban interface exploded.
The wildland-urban interface being the areas where housing developments push directly into natural combustible forests and brushlands?
Yes. Insurers found themselves unable to charge a premium that accurately reflected the catastrophic risk of entire neighborhoods burning down. The actuarial math broke.
So what's the solution? Just leave.
Basically, yeah. Carriers like Cincinnati Financial are simply refusing to write new business in certain zip codes, or they're aggressively non-renewing existing policies. So that 1% growth rate in personal lines isn't a failure of sales. It is a deliberate amputation of unprofitable exposure.
Which ties into a massive structural pivot the company is executing. Because they aren't just fleeing California brush zones, they are aggressively shifting their entire personal lines focus away from the standard middle market homeowner and pivoting hard toward high net worth clients. CEO Steve Spray highlighted that high net worth now makes up over 60% of their personal lines business.
And the high net worth insurance market is a fundamentally different business model than standard home and auto.
Right.
We aren't talking about a $400,000 suburban house here.
Right.
We're talking about $10 million coastal estates, private art collections, multiple luxury vehicles, and massive umbrella liability policies.
But wait, why pivot there? If the combined ratio is already struggling, why concentrate risk into massive multi-million-dollar payouts? That seems counterintuitive.
Because the margins are historically much wider, and the clients are way less price sensitive. A high net worth individual values bespoke service, guaranteed replacement costs without depreciation, and comprehensive liability shields over, saving a few $100s on a premium.
Okay, so they're less likely to haggle over rate hikes.
Exactly. Furthermore, the loss frequency is often lower. These properties are built with better materials, they have advanced security and fire suppression systems, and the clients have the resources to properly maintain them.
So they're basically trading high-frequency, low-severity claims like fender benders and standard roof leaks for low-frequency, high-severity claims. But this still leaves us with the ugly 100.8% combined ratio. If they're so disciplined and they are capturing this highly profitable demographic, why are they technically operating at a loss?
This is where we have to isolate the signal from the noise. And the transcript provides the exact metric needed to do it. The ex-catastrophe combined ratio.
Ah, the ex-cat ratio.
Right. When you strip out the volatile, unpredictable acts of God, the Saudi Arabia conflicts, the freak event cancellations, the clusters of severe convective storms, the combined ratio for the first 6 months of the year drops to an incredibly healthy 87.8%.
Wait, 87.8%.
Yes.
So on their day-to-day predictable business, they are keeping roughly 12 cents of profit for every dollar they take in before they even invest the money. That fundamentally changes the narrative. It proves the underwriting models actually work.
It does. The 87.8% ex-cat ratio is the true pulse of the company. It confirms that the underwriters are accurately pricing the attritional risk, the normal fires, the standard auto accidents, the slip and falls. The core machine is highly profitable.
So they didn't suffer a 100.8% combined ratio because they're bad at insurance?
No, they suffered it because weather and geopolitical events clustered abnormally in a single 3-month window.
Which means the underlying business is generating a massive amount of cash. And since an insurance company collects premiums up front and pays claims later, they are sitting on a mountain of capital. This brings us to the second major theme of the earnings call, the fortress balance sheet.
Yes, the balance sheet is key here.
Because Cincinnati Financial isn't just an insurance company. They are a massive, highly sophisticated investment fund holding billions of dollars of policyholder money.
The concept you're describing is float. Warren Buffett famously built the Berkshire Hathaway empire on this exact principle.
Right, collect now, pay later.
Exactly. An insurance company collects a premium in January, but the claim might not occur until October, and the lawsuit might not settle for 3 years. In the intervening time, the company invests that float to generate absolute returns.
And right now, the float is generating massive yield. CFO Mike Sewell spent a lot of time on the call running through the investment metrics, and they are remarkable. Overall investment income grew by a very strong 12%, and the primary driver was a 14% increase in bond interest income.
We really have to contextualize this within the macroeconomic environment. For over a decade following the 2008 financial crisis, the Federal Reserve maintained a zero interest rate policy.
Right. Money was basically free.
Yeah. And insurance companies, which are mandated by regulators to hold the vast majority of their assets in highly rated, safe, fixed income securities, they suffered. They were earning negligible yields on billions of dollars.
But the inflation shocks of 2021 and 2022 changed the game. The Fed hiked rates aggressively, and suddenly the bond market became a cash machine for insurers.
Exactly. As their old, low-yielding bonds mature, Cincinnati Financial takes that principle and reinvests it into the current market. Sewell noted that their average pre-tax yield on the fixed income portfolio has climbed to 5.08%.
That's a huge jump from a few years ago.
It is. And for newly purchased taxable and tax-exempt bonds during the second quarter, the yield was even higher at 5.66%.
So they are clipping coupons at over 5% on a bond portfolio worth billions, and it compounds the strength of their balance sheet. Their total investment portfolio sits at an incredibly healthy $8.6 billion net appreciated value. They have $8.9 billion in unrealized gains on their equity portfolio alone. I mean, they are just swimming in liquidity.
They are. But the critical question for any investor is how management deploys that liquidity.
Right.
With a highly profitable core underwriting engine, evidenced by the 87.8% ex-cat ratio and a surging investment portfolio, where is the cash going? Well, the transcript reveals they are deliberately funneling a massive portion of it into their loss reserves.
They are hoarding the cash. The numbers are staggering. They added $981 million to their property casualty loss reserves in just the first half of 2026.
Almost $1 billion.
Almost $1 billion set aside for a rainy day. But what is crucial to understand is that they aren't just setting this money aside for claims they are actively investigating. A massive chunk of it, $845 million, was specifically allocated to the IBNR portion of their reserves. Can you explain IBNR?
Yeah, IBNR is the most complex and conservative lever in insurance accounting. It stands for incurred but not reported.
Incurred but not reported, okay.
Right. This is capital set aside for claims that have physically happened in the real world, but the insurance company has absolutely no knowledge of them yet because the policyholder hasn't actually filed the paperwork.
Okay, let me make sure I understand the mechanics of this. If I own a commercial construction company and my crew poorly installs a roof on a warehouse today, the error has occurred. The liability has been incurred.
Correct.
But the warehouse owner doesn't know the roof is defective until a massive rainstorm hits 3 years from now, causes millions of dollars in water damage to their inventory, and triggers a lawsuit against my company. So Cincinnati Financial is taking cash today and locking it in a vault for a roof leak they don't even know exists, which won't be reported until 2029.
That is a perfect explanation of a long-tail liability. Property claims are usually short tail. A hurricane hits, the house is damaged, the claim is filed within weeks. But casualty claims liability, professional negligence, workers' compensation are long tail. They can take years to manifest and years of litigation to settle.
Okay, so why are they stuffing $845 million into IBNR specifically right now?
The reason management is aggressively padding the IBNR reserves right now, specifically on the commercial casualty side, is driven by a systemic threat they refer to as legal system abuse.
Legal system abuse? It sounds like corporate jargon for we don't like getting sued, but the industry usually refers to this as social inflation, right?
Yes, social inflation. And it is arguably the single greatest threat to casualty insurers today. It's the quantifiable trend of jury awards and settlement costs rising at a pace that far exceeds general economic inflation. We're seeing a proliferation of nuclear verdicts, which are jury awards exceeding $10 million for incidents that historically would have settled for a fraction of that amount.
That's insane. What is driving the juries to award these massive numbers?
Well, it's a confluence of factors. Plaintiffs' attorneys have become incredibly sophisticated. They utilize reptile theory tactics in courtrooms to appeal to the survival instincts of jurors, basically painting corporate defendants as existential threats to public safety.
Wow, okay.
Furthermore, the rise of third-party litigation funding has transformed lawsuits into an asset class.
Wait, hedge funds are investing in lawsuits?
Exactly. Hedge funds and private equity firms are financing massive lawsuits in exchange for a percentage of the settlement. This means plaintiffs have the financial stamina to drag out litigation for years, refusing early settlement and rolling the dice on a sympathetic jury.
Because they aren't paying the hourly legal fees out of pocket anymore.
Right, the private equity firm is covering it.
So management is looking at this hostile legal environment and deciding they cannot trust the historical data to predict future settlements. They are padding the reserves to protect themselves from these nuclear verdicts.
That's exactly it.
It feels like keeping 3 extra spare tires in the trunk of your car because you refuse to trust the state of the local roads. I mean, it guarantees you will never be stranded, but the extra weight slows the car down and ruins your gas mileage. The financial equivalent being that these massive reserve additions drag down current earnings. So are they artificially depressing this quarter's profits by being overly paranoid?
Analysts debate this constantly with conservative management teams. Is it prudent risk management or is it earnings management? Are they hiding profits in the couch cushions to smooth out future quarters?
Right.
But the transcript provides concrete evidence that this conservative philosophy works, and it actually generates profit over the long term. CFO Mike Sewell reported $42 million of favorable reserve development from prior accident years during this quarter.
Favorable reserve development, meaning the claims they feared in the past actually came in cheaper than they expected.
Exactly. 3 or 4 years ago, they exhibited this exact same paranoia. They saw the rise in social inflation, they put the 3 spare tires in the trunk, and they booked massive IBNR reserves.
Okay, I follow.
But as those older accident years mature and the claims are finally resolved and paid out, it turns out they overestimated the severity. They didn't need the entire vault of cash.
So what happens to the leftover money? Does it just sit there?
No, it flows directly back onto the income statement as profit in the current quarter. That $42 million in favorable development improved their combined ratio by 1.7 percentage points right now. Their past paranoia literally financed this quarter's earnings cushion.
That is just a masterclass in balance sheet protection. By sacrificing maximum profitability in the short term, they eliminate the risk of a catastrophic reserve charge in the future.
Absolutely.
We've all seen the headlines where a major insurer suddenly announces they under-reserve for past years, they are $1 billion short, and the stock plummets 20% in a single trading session. Cincinnati Financial is structurally engineering that balance sheet to ensure that never happens.
They're prioritizing the long-term preservation of book value over short-term EPS beats. It is the defining characteristic of their corporate culture.
Okay, we have dissected the underwriting mechanics, the geopolitical and weather anomalies, and the fortress balance sheet. Now we need to look at management's guidance and the future pressures facing the company as we move into the back half of 2026. And the most glaring point of friction highlighted in the analyst Q&A is expense management.
Right, expenses. CFO Mike Sewell stated a very specific operational goal here. He wants the growth rate of their non-commission expenses to remain lower than the growth rate of their written premiums.
On the surface, that is just basic business hygiene. Don't let your fixed costs grow faster than your revenue. But as we've established, their premium growth has slowed to a crawl. It's at 3%.
That is the friction point. An insurance company requires massive fixed infrastructure, core underwriting systems, actuarial software licenses, cloud computing, and highly specialized salaries for data scientists and underwriters.
Right, and inflation hits those costs too.
Exactly. We are operating in a macroeconomic environment where the cost of technology and human capital is inflating rapidly. Keeping the growth of those internal expenses below a 3% threshold will require ruthless operational efficiency. Sewell acknowledged the difficulty, stating, "My job might be a little bit harder, but I think we'll be able to do it."
But I see a massive strategic contradiction here. Management is stressing over keeping internal expenses below 3%, but they completely refuse to trim their single largest variable cost, agent commissions.
Oh, they won't touch commissions.
No. CEO Steve Spray spent a significant portion of the call praising their independent agent relationships, openly bragging that their primary commission schedule is a top pair across the board and that their profit-sharing contracts are above average. If top-line revenue is stagnant, why are they refusing to cut the biggest expense line item?
To understand why they refuse to cut commissions, we have to understand the distribution model of the property and casualty industry. There are direct writers like Geico or Progressive where the consumer buys the policy directly through a website or a 1-800 number. The insurance company owns the customer relationship and keeps the entire premium.
Right, no middleman. But Cincinnati Financial doesn't operate that way.
Not at all. They rely entirely on the independent agency channel. These are local, privately owned brokerage firms embedded in communities. The crucial distinction is that the independent agent owns the relationship with the client, not Cincinnati Financial.
Okay.
The agent evaluates the client's risk, goes out to the marketplace, and decides whether to place that client with Cincinnati, Chubb, Travelers, or Hartford.
So the independent agent is the gatekeeper. And if Cincinnati Financial decides to shave a few percentage points off the commission structure to improve their quarterly expense ratio, the agent will simply steer the business to a competitor who pays better.
Exactly. And let's connect this to the strategic pivot we discussed earlier, the aggressive push into the high net worth market. A client with a $5 million coastal estate, a collection of vintage automobiles, and a complex family trust does not buy their insurance on an iPhone app.
They definitely don't.
No, they rely on a sophisticated, trusted, independent advisor to build a bespoke risk management portfolio.
It all clicks together. If Cincinnati Financial alienates the independent agents by cutting their compensation, they instantly cut off their access to the exact high net worth demographic they're desperately trying to acquire.
Spray specifically noted on the call that independent agents are affording Cincinnati premier high net worth carrier status. That status is a competitive moat. It takes decades of relationship building, claims paying reliability, and yes, generous profit sharing to build that trust.
Right. You can't just buy that overnight.
Exactly. You do not jeopardize a pipeline of highly profitable, complex risk to satisfy a short-term analyst demand for expense reduction. The long-term value of a loyal, highly incentivized agency channel far outweighs the near-term margin pressure.
It's corporate relationship investing. You pay a premium for distribution because the quality of the risk they bring you generates a higher ex-catastrophe margin. Okay, we have covered an immense amount of ground. We have unpacked the $1.3 billion phantom income, the 100.8% combined ratio dragged down by geopolitical conflict and heat waves.
The hidden strength of the 87.8% core underwriting, too.
Yes, and the nearly $1 billion stuffed into reserves for social inflation and the unbreakable bond with the independent agent. It's time to synthesize all of this data into a firm, actionable conclusion for the retail investor listing. What is the definitive bottom line on Cincinnati Financial?
The bottom line is highly bifurcated based on the type of investor you are. This Q2 2026 earnings report is a distinctly bearish signal for the momentum trader or the aggressive growth chaser, but it is a cautiously bullish, highly validating signal for the conservative, dividend-focused value investor.
Let's break down the bearish case first. If you are looking for explosive top-line revenue, you are in the wrong place.
The revenue is only expanding at 3%. Management is actively retreating from major markets like California, prioritizing margin over scale. If you just read the headlines, the 100.8% combined ratio and the year-over-year drop in operating income from $311 million to $224 million look genuinely terrible. For a growth investor, there is simply no catalyst here to drive rapid multiple expansion.
But the value case is built entirely on the balance sheet and the core underwriting strength.
The underlying 87.8% ex-catastrophe combined ratio proves the internal machinery of the company is pricing risk beautifully. They lost money on the underwriting side this quarter solely because of a statistically anomalous clustering of weather and global events. And because the core machine works and the investment portfolio is yielding over 5%, the actual intrinsic value of the company is surging. CFO Mike Sewell proudly announced a record high book value of $108.64 per share.
A record high book value. Despite the underwriting loss, despite the catastrophe hits, the actual net worth of the company's assets on a per-share basis has never been stronger. And management's capital allocation strategy screams confidence, doesn't it?
It really does. They paid out $143 million in standard dividends this quarter. But the most actionable signal for the retail investor is the share repurchase program. Management bought back 1.3 million shares at an average price of $161.93, deploying $216 million in a single quarter.
While the broader market might have been spooked by the weather losses and the 100.8% combined ratio, the executive team quietly bought $250 million of their own stock.
Year to date, they have repurchased 2.4 million shares. A management team does not deploy that level of capital into buybacks if they believe their underwriting models are broken.
No, they'd be hoarding that cash to pay claims.
Exactly. They're signaling absolute faith in the 87.8% core ratio and the massive reserve cushion they have built. By reducing the share count, they are artificially boosting future earnings per share and essentially paying the existing shareholders to sit back, collect the dividend, and wait out the weather.
They are paying you to wait out the weather. It's a powerful position to be in if you have the patience. But before we close out this analysis, I want to leave everyone with a final provocative thought. Something that takes the core strategy of Cincinnati Financial and stress tests it against the reality of our changing world.
The floor is yours.
We established that Cincinnati Financial is pivoting aggressively into the high net worth personal line space, which now comprises over 60% of that specific book of business. They are fleeing standard California tract homes and chasing the mega mansions, the custom coastal estates, the multi-million-dollar mountain retreats. But we also just spent a lot of time discussing the increasing frequency and severity of bizarre extreme weather events. The climate is becoming demonstrably more volatile, and traditional actuarial models are struggling to keep up.
The frequency of billion-dollar weather events is rising exponentially.
Right. So here is the macro question for you to ponder. What happens when climate change disproportionately targets these massive, hyper-expensive luxury properties? If an average middle-market suburban home burns down in a wildfire, it costs the insurance company $400,000 to rebuild. If a high-net-worth estate nestled in a coastal canyon burns down, it costs them $15 million, plus the replacement of custom art and luxury vehicles.
Yeah, it's a massive concentration of risk.
Exactly. Is Cincinnati Financial actually reducing their overall risk profile by exercising this pricing discipline? Or by concentrating their business into the high net worth demographic, are they simply trading a large number of standard, highly predictable risks for a concentrated, hypervolatile dose of luxury catastrophic risk?
It's the ultimate test of their underwriting discipline.
When the next unprecedented, unmodeled storm hits an affluent zip code, will that fortress balance sheet and those IBNR reserves be enough to absorb the shock? Or will the concentration of wealth prove to be their greatest vulnerability? It's a structural risk that every investor holding the stock needs to ponder. We'll see you on the next deep dive.